Hi, I'm Miranda from Finance Talking, and today we're going to be talking about balance sheets. So balance sheets, or another name for a balance sheet, is a statement of financial position. Statement of financial or SOFP for short. So what is a balance sheet? Well, it's like a financial snapshot of a business at a point in time. It's as though someone took a digital camera and pointed it at a business and said, this is what you own. So these are your assets at a point in time. And this is how those assets are funded. So the balance sheet will show the assets and the funding at a point in time. Now we're going to look at two different aspects of a balance sheet today. We're going to start off by thinking about a personal balance sheet. And then we're going to look at what a business balance sheet might look like. So first of all, let's think about our personal balance sheet. Remember, this is just a snapshot of what we own and what we owe at a point in time. Now, if we're lucky enough to own a house or an apartment, then our house is going to be our biggest asset. So we'll put house plus contents. And then the other big things that we might own, we might own a car, and we might have some cash. So there's our total assets in our business, or our house, our personal assets rather in this instance. Now on the funding side, it's likely that we needed a mortgage to buy our house, and that's likely to be the biggest part of our funding. And then other than that, we may have some unpaid bills. So things like utilities, telephone bill, that sort of thing. And we might owe some credit card balance, or we might have a car loan, another sort of liability. Now, if we're lucky enough to have enough assets to pay off our liabilities and have some spare, then the balance is what we might refer to as our equity, or maybe more likely in personal situation, we might call it our net worth. Our net worth being what we have if we use all our assets to pay off our liabilities. It's what we've got left, our equity. And you can see that because the net worth is the balancing figure, the assets must always equal the funding. And that's why it's called a balance sheet, because it must balance. So that gives you an idea of how a balance sheet works. Now let's see if we can translate that to a business. So we're going to think about a manufacturing business, because that'll be quite easy to get our head around. And the biggest asset that we'll have in our business is likely to be factories and equipment. So we'll make half of our assets property, plant and equipment, or PP&E, you'll sometimes see it written down as. And we'll put some numbers in here. So we'll say we've got 50 of PP&E, property, plant and equipment. Then we might have some inventories. So inventories is the stock of goods to be sold. It will actually include finished goods and also part finished goods and raw materials. So we'll say we've got 20 of inventories. And then it's likely that we extend our customers credit. So we're likely to have some receivables. So that's customers who owe us money. It's an asset because they owe us money. We'll receive the cash in due course shortly, probably. And then finally, we'll have some cash. So again, we'll put some numbers to those. We'll say we've got 20 of receivables and 10 of cash. So you can see if we add all that up, we've got total assets of 100. So we'll put assets up here. Total assets are 100. Now let's look at the funding side. Well, the likelihood is that we have some payables. So this is money that we owe to suppliers and for our overheads. So a bit like our unpaid bills in our personal balance sheet. And we'll assume that we have a bank loan as well. So we'll say the payables are 30 and the bank loan are 20. So if we use our assets, which are 100, to pay off our liabilities, which are 50, then by definition, our equity in our balance sheet will be the remaining 50, which then makes the funding side of the balance sheet also add up to 100 and our balance sheet balances. And actually this equity will be made up of two things: the capital that the shareholders put in to buy their shares, plus any retained earnings, any profits that the company's made since then, which have been retained in the business or invested on the shareholders' behalf back into the business. So that's the equity. And again, we could think of this as being net assets or net worth, in the same way that we did in our personal balance sheet, because you can see that the net assets are 100 of assets minus 30 minus 20 of liabilities, which equals 50. And that is the same thing as the equity of 50 there. That's the basics of balance sheets.